3 years of absolutely nothing. No movement, no headlines, no excitement, just a flat line so boring it would put a doctor to sleep. And I want to tell you something that took me a long time to learn, something that goes against every instinct you have as a person who watches their money. That flat line is exactly where the money is. Most people walk past stocks like this. They're looking for the exciting one, the stock that's already up 40% this year, the one their brother-in-law won't stop talking about at Thanksgiving. They want the sizzle. But I'll tell you what I found over decades of picking through companies, reading annual reports at midnight, driving through strip malls, counting parking lots to see which stores are busy. The ones that have already moved, you're usually too late. The ones that look like they're going nowhere, that's where you want to be early. This stock is $17. The company has been quietly growing its revenue at over 35% a quarter. It holds the only FDA-cleared test of its kind in a market worth billions of dollars. Insurance covers it for over 300 million Americans. More than half the blood cancer specialists in the country already use it, and 85% of the potential market hasn't even been touched yet. The stock has done nothing since 2022. And this year, for the very first time, the company is expected to turn profitable. Now, before your eyes glaze over and you start scrolling, I want you to stay with me for just a second, because I'm not here to hand you a hot tip and send you off. I've never believed in that. What I want to do is teach you how to see what most people miss. And if you understand the pattern I'm about to show you, the same pattern I've watched play out over and over again across some of the most extraordinary wealth-building opportunities of the last half-century, then this $17 stock will make a lot of sense. And so will the next one after it. Let me start with something that should be obvious, but somehow nobody talks about. The stock market rewards two kinds of people: the people who got in early and the people who got lucky. And since I've never been much of a gambler, I spent most of my life trying to figure out how to be the first kind of person. How do you find something before it moves? How do you see around the corner? And the answer, honestly, is simpler than most people want it to be. You stop chasing excitement and you start looking for compression. Here's what I mean. Imagine a spring, one of those old metal springs you'd find in a mattress. If you push it down for a second and let go, it bounces back a little. Push it down for a month, it bounces harder. Push it down for 4 years and then let go. That thing launches across the room. That's what happens to a stock that goes sideways for years while the business underneath it keeps quietly growing. The stock price and the business performance get further and further apart, and at some point, not always, not on schedule, but eventually the market wakes up and closes that gap fast. That's not a theory I invented. That's just what I've watched happen again and again. Tesla did it. Sat basically flat for years while everyone was writing Elon's obituary. While the headlines were full of bankruptcy predictions, while the shorts were smug and loud and absolutely certain, meanwhile, the company was building gigafactories. They were ramping up production on the Model 3. Revenue was growing. The business was compressing that spring down hard. And then one year it just went, not a little, 10 times, 17 times, depending on where you bought it. Netflix did the same thing. Crashed 80% in 2011. People said streaming was a fad. And for a year or two, nothing happened. The stock just sat there while they were quietly adding 2 million subscribers. Every single quarter, the business was doing exactly what it was supposed to do, and the market was completely ignoring it until it couldn't anymore. Apple 2015 to 2018, 4 years of basically nothing. People thought Apple was finished growing. But underneath that flat stock chart, the iPhone install base was expanding, services revenue was compounding, and the company was buying back billions of its own shares, and then the stock went up 90% in a single year, and then it doubled again and again. I'm not telling you these stories to make you feel bad about missing them. I'm telling you because the pattern repeats, not always with the same company, not always in the same sector, but the mechanics are the same. A good business, a flat stock, growing fundamentals, and a moment when the market finally pays attention. So the question I always ask, the one I've been asking my whole life is, where is the spring being compressed right now? And that brings me to this company, Adaptive Biotechnologies. Ticker is ADPT. Stock's been trading around $17, and it's been sitting basically at 2022 levels ever since. No real movement in 2022, no real movement in 2023, nothing in 2024, nothing much in 2025. If you were just looking at the stock chart, you'd think this company was a zombie. But the business tells a completely different story. What does this company actually do? Let me put it in plain English, the way I'd explain it to my neighbor. Every 3 minutes in America, someone is diagnosed with blood cancer. Leukemia, lymphoma, myeloma, these diseases are devastating. And treatment, chemotherapy, all of it is brutal. But patients get through it, And when they do, when the doctors say the treatment worked, there's this terrifying question hanging in the air. Did we actually get all of it? Because here's the thing, even if a regular blood test comes back clean, even if a scan shows nothing, there can be cancer cells still hiding in the body, invisible, microscopic, one single cancerous cell hiding among a million healthy ones. And if that cell is left behind, the cancer comes back. And by the time a normal test catches it, it's grown, it's spreading. The window for early action is closed. Adaptive Biotechnologies makes a test called clonoSEQ, and what it does is extraordinary when you think about it. Every cancer has what you might call a unique fingerprint, like a barcode, specific to that patient's cancer. clonoSEQ reads a patient's blood and searches for that specific barcode, and it is so sensitive, so precisely calibrated, that it can find one single cancer cell among a million healthy ones. Think about what that means. It's like being able to find one specific person by their fingerprint somewhere in the entire city of Dallas. That's the sensitivity we're talking about. A regular checkup is like walking through your house looking for fire. If you see flames, obviously something's wrong. But clonoSEQ is a smoke detector. It catches the wisp of smoke before the fire ever starts, before the cancer comes back, before it spreads, before the treatment options shrink. And for patients and doctors, that early warning changes everything. Your oncologist can adjust your treatment while the window is still wide open instead of waiting until it's slammed shut. Now here's where it gets interesting from an investment standpoint. And I want to be clear, this is a high-risk investment. Biotech always is. Companies can fail, drugs don't get approved, competition shows up, management makes mistakes. I've learned that lesson enough times to have the scars to prove it. So everything I'm about to say, you have to weigh against the risk, position size accordingly. Don't put money in that you can't afford to leave alone for a few years. But here's what I see when I look at this company through the lens of the pattern. First, is the business growing while the stock is flat? Yes. Revenue growth of 35% last quarter, 51% the quarter before, 102% the quarter before that, 4 years of consecutive growth. The business is doing exactly what you'd want it to do, getting bigger, getting more efficient, expanding its reach, while the stock has sat at $17 like it's waiting for a bus that never comes. Second, is there a durable advantage here? Something that keeps competitors from just walking in and taking the market? Yes. clonoSEQ is the only test of its kind that's been cleared by the FDA, not just approved for one use, the only one of its kind, with over 250 peer-reviewed medical studies backing it up. More than half of all blood cancer physicians in America already use it. More than 160 pharmaceutical companies are using it in their clinical trials to measure whether their new cancer drugs actually work, and insurance covers it for over 300 million Americans. Patients can get this test without paying out of pocket. That's a massive commercial advantage. When something's covered by insurance, the friction to use it disappears almost entirely. And yet, and this is the part I keep coming back to, they're still at less than 15% in most of the cancers they treat. The only FDA-cleared test, the half of doctors on board, insurance coverage in place, and 85% of the opportunities still untouched. Third, what's the catalyst? What forces the market to pay attention? This year, for the very first time in the company's history, Adaptive Biotechnologies is expected to become profitable. They've been losing money for years, the way most biotech companies do when they're building something from scratch, pouring everything into research, clinical studies, sales teams, regulatory approvals. And now, on the cusp of all that work starting to pay off, they're forecasting their first year of profitability. I've seen this moment happen before in other companies. When a business flips from losing money to making money, it's like someone turns on a light in a dark room. All of a sudden, investors who wouldn't touch it before, pension funds, institutional money, value-oriented buyers can now justify owning it. It shows up on screens it never showed up on before. Analysts who ignored it start writing about it. And the stock, which has been sitting there for years like it's invisible, suddenly gets very visible very fast. The total market Adaptive can go after is about $6 billion. They're doing about 5% of that right now, roughly $270 million in projected revenue if they're the only FDA-cleared player. If they keep growing at the rate they've been growing, if they execute on what they've already built, a larger slice of that market isn't a fantasy. It's a logical progression. The entire company is worth about $2.7 billion right now. If they capture even a quarter of that $6 billion market, $1.5 billion in revenue, with the margins a company like this can generate, the valuation math starts to look very different from where it sits today. Now, I want to pause here for a second because I feel like I should say something that doesn't get said enough in these kinds of discussions. I've been wrong before, many times. I bought stocks that had every ingredient I was looking for and they still didn't perform the way I hoped. Sometimes the catalyst takes longer than expected. Sometimes management fumbles it. Sometimes a competitor comes out of nowhere. And in this case, there's already a competitor, a company called Natera, expanding into blood cancers. Competition is real, risk is real. The stock went from its peak down 87%, not 10%, not 30%, 87%. That's the reality of small biotech investing. It is not for the faint of heart. And it is not something you put your mortgage payment into. What it is an interesting opportunity for someone who understands the framework, who can afford to take on that level of risk with a portion of their portfolio, and who has the patience to let the thesis develop. And patience is really the whole game here. That's the part people skip. They want to buy a stock on Monday and check it on Friday and be rich by the weekend. But the greatest wealth in the stock market, the wealth that actually changes families, that actually compounds over years into something meaningful, it's built by people who bought when nobody else was paying attention and then held on long enough to let the business prove itself. I used to say that the biggest money I ever made was in stocks. I almost didn't buy because they seemed too boring, too quiet, too obvious in a dull kind of way. And the stocks that felt exciting when I bought them, a lot of them taught me expensive lessons. Before I go any further, if this is resonating with you, if you're starting to see markets a little differently than you did 15 minutes ago, I want to invite you to take one more step. Everything I'm covering today, including the deeper research on this specific company, the full financial picture, the risks, the competitive landscape, all of it is available for free if you go to felixfriends.org ADPT. That's ADPT, the ticker. You put together a complete research report, download it, read at your own pace, come to your own conclusion. That's how this is supposed to work. Not hype, not rush, just information laid out clearly so you can decide what's right for you. Let me walk you through what I actually look for when I'm evaluating something like this, because the specific stock matters less than the framework. If you understand the framework, you can find the next one yourself. I look for a stock that's been going sideways for at least 2 years, not down sideways. Down is a different story and usually a different problem, but sideways with a business that's quietly growing underneath. That's the spring. I then ask whether the fundamentals are getting better even though the stock isn't moving. Revenue growing, margins improving, customer base expanding, debt manageable. If the answer is yes across the board, I get more interested. Then I look for volume patterns. Very quietly, over time, on the green days, is there more buying activity than there used to be? Are the red days getting smaller in terms of selling volume? Because when the smart money is starting to position slowly, patiently, without making a fuss, you can sometimes see it in the volume before you see it in the price. And then I look for the catalyst and the thing that forces the market to reassign the value. It could be profitable, like in this case. It could be a major clinical trial result. It could be a partnership with a large company. It could be regulatory approval for a new product. It could be earnings that finally, for the first time, exceed what Wall Street was expecting. Whatever it is, the catalyst is the moment the spring releases. And if you're already positioned before that moment, if you bought when it was boring, when nobody was talking about it, when the chart looked like a coma, that says when you participate in what happens next. The three questions I always come back to: is the business growing while the stock is flat? Is there something protecting this company from competition? And is there a specific identifiable event coming that forces the market to revalue it? If the answer to all three is yes, I start paying very serious attention. With adaptive biotechnologies, I believe the answer to all three is yes. Growing revenue for 4 years straight. FDA exclusivity with 250 supporting studies and more than half of blood cancer doctors already on board. And profitability arrives for the first time this year. That's a combination that doesn't come along often, especially at $17 a share. Now, let me tell you about the risk one more time because I mean it. The stock fell 87% from its peak. It is a small company in a competitive space. There's no guarantee the profitability holds. There's no guarantee they continue growing at 35% a quarter. Natera is a real competitor and they're not sitting still. Biotech has eaten portfolios whole before, including mine, and it probably will again in some form or another. You should not bet money on this that you cannot afford to have locked up or even lose, period. But I'll also say this: the stocks that ended up making the most difference for the people who bought Apple in 2015 when it was flat and held through 2019, for the people who bought Netflix when everyone was calling it a fad, for the people who bought Tesla when the bankruptcy crowd was loudest, they weren't buying because it felt safe. They were buying because the business made sense, the valuation was low, and the crowd was wrong. The crowd is usually wrong. Not always, but usually. And the crowd right now is completely ignoring the stock, which is exactly where I like to start looking. There's something I've always found interesting about the way regular people invest versus the way wealthy families invest. Most regular people buy what they already know about. Big brand names, household companies, things they've read about in a magazine or heard about on the news, and there's nothing wrong with that. But by the time it's in the news, the move has usually already happened. The wealthy families I've studied over the years, the ones who compounded real wealth over decades, they bought things before they were talked about. They bought something boring, they bought quiet, they bought the spring before it was released. And that's really the whole lesson here, not just about this one stock, but about how to think about markets. The best opportunities rarely feel like opportunities when you find them. They feel like nothing. They feel like a waste of time. They feel like a stock that's going nowhere. And then one day, not today, maybe not next month, maybe not even next year, but one day, you look at your account and you realize that the boring $17 stock you bought when nobody cared has turned into something. That changed the trajectory of what your money can do for your family. That's not luck. That's pattern recognition. That's what happens when you stop chasing noise and start following the fundamentals. The download is free. The research is free. The framework is yours to keep. Go to felixfriends.org/ADPT and read everything Hugh put together. Spend a weekend with it. Ask yourself the 3 questions. Make your own call. I've been studying businesses my whole life. Thousands of companies. And the ones I regret missing the most weren't the ones that moved fast. They were the ones I saw early, walked away from because they weren't exciting enough, and then watched from the sidelines when the spring finally released. Don't walk away from this one until you've at least looked. That's all I'm asking. Look at the business, read the numbers, understand what they do, and then and only then decide if it belongs in your portfolio. The market rewards patience more than anything else. Not brilliance, not timing, not gut feelings. Patience combined with a little bit of homework, that's the whole secret. And if you remember nothing else from today, remember that the spring that's been compressed the longest has the most energy stored up inside it. Right now, there's a $17 stock that's been compressed for 4 years. The business underneath is growing. The competitive moat is real. The catalyst is arriving, and almost nobody is paying attention. That's the part that gets me most excited.